Germany takes its foot off the debt brake as the Bundestag agrees on a fiscal bazooka of infrastructure and defence spending.
Germany is doing what would have been unthinkable just a few years ago. It's stepping away from the strict rules it once wrote for Europe. Within weeks of being elected, Germany's new coalition government, headed by the conservative CDU under Chancellor Friedrich Merz, announced a historic fiscal package. It promised to loosen spending rules.
It really was very restrictive on what governments could do to support the economy.
And modernise a sluggish economy.
This country needs an economic turnaround.
This shift didn't come from nowhere. It was the product of years, even decades of unresolved economic strain, from industrial slowdown to energy cuts, rising global competition, and politicians often too cautious to act.
There were no reforms under all these 16 years with Angela Merkel, and in the end, we are actually witnessing the results of that period now.
Germany's last government, led by Olaf Scholz, had also prioritised these reforms, but struggled with getting them over the line.
And now we have to start tackling our structural crises that accumulated in the past.
I think it goes much farther than even having to adapt only. I think we have to reboot. We will need a new model because a lot of things have changed.
So why now? Why is Germany taking this risk, and how could it impact the country's future? To understand that, we need to go back to the 2008 financial crisis. The root of Germany's economic cautiousness stretches back to this point in history when the global financial system nearly collapsed. While the crisis began with the US mortgage market, the effects were far-reaching. Europe was hit hard and Germany's economy was feeling the impact. Annette Weisbach has covered Germany for CNBC for more than 15 years.
Not a lot of people remember is that Germany was one of the worst affected from the banking crisis because a lot of these German state-backed institutions did have a lot of exposure to subprime in the States because they wanted to shore up their profitability. And of course, with the crash of the subprime market, they crashed as well.
The crisis knocked Germany's confidence. Despite being home to some of the most influential companies in the world, Volkswagen, Siemens, Adidas and SAP to name just a few, this was a warning that even Europe's largest economy wasn't immune to the issues lying beyond its borders. In response, German policymakers implemented a new fiscal rule known as Schuldenbremse, or the debt brake. Franziska Palmas is a senior economist focused on Germany.
The debt brake is Germany's national fiscal rule. Its main aim is to prevent the government from taking on too much debt. It was introduced just after the global financial crisis because actually before then, Germany had been running fairly large budget deficits and its debt ratio was increasing. It was really felt in Germany that there needed to be some form of rules that basically prevented governments from continuing to run fairly large deficits and cause the debt ratio to keep rising.
The rule put a strict limit on how much the federal government could borrow, even when business was booming, stating that the budgets of the federation and the lender shall in principle be balanced without revenue from credits. And for a while, this discipline seemed to pay off. Germany weathered the Eurozone crisis in the early 2010s, building its reputation as Europe's economic rock. In 2014, the country's finance minister proudly presented a balanced budget for the first time in 45 years. But underneath, cracks were beginning to show. In December 2021, Angela Merkel stepped down after 16 years in office. At the time, her tenure was widely celebrated. She was credited with growing Germany's influence and successfully leading the nation through several global crises with her pragmatic approach. But critics say Merkel's era left key reforms on hold. She was succeeded by a three-party coalition led by Olaf Scholz and the centre-left Social Democrats, a government that promised fresh ideas and renewal. The debt brake, which had been paused in 2020 to allow the country to respond to the COVID-19 pandemic, was set to come back into force in 2023. But the crises continued to pile up. The war in Ukraine, energy shocks and inflation all added to the growing list of upheavals expanding the need for public spending. In 2022, following Russia's invasion of Ukraine, the government secured an amendment to establish a €100 billion defence fund that would be exempt from the borrowing restrictions. But the three coalition parties, all with significant ideological differences, were struggling to find unity. By 2023, Germany's growth had stalled, with its gross domestic product shrinking by over 0.25%. Its GDP then declined again the next year. This was the country's first full-year decline since the pandemic-induced recession of 2020. It was the only G7 major economy to record negative growth after 2020, highlighting the depth of the challenges it faces and the urgency for change.
Germany's economy is no longer attractive to invest because of red tape, because of too high energy prices, and that companies rather prefer to invest somewhere else. And that needs to change.
Germany is struggling with higher energy prices than, for example, in some other countries, higher wages, some labor shortages as a result of the shrinking working age population. So those are all factors that, in some sense, weigh on the prospect for Germany as a place to invest.
As for Olaf Scholz, it was ultimately the debt brake that would be the coalition's undoing. Finance Minister Christian Lindner, who led the pro-business Free Democrats, refused to loosen spending limits, and so Scholz eventually fired him, saying that he had betrayed his confidence. In late 2024, Chancellor Olaf Scholz's coalition government collapsed.
Germany's three-party coalition has collapsed.
Chancellor Olaf Scholz has lost a vote of confidence in Parliament.
Polls in Germany have opened for voters to decide which party will run their next government.
In February 2025, a snap federal election was held. The election resulted in a significant shift in the political landscape, with the conservative CDU-CSU securing victory and the far-right AfD emerging as the second largest party.
Germany's conservative CDU party looks set to win the country's election, with the AfD far-right party in second place.
After years of stagnation and facing pressure from both business and the public, the government voted to amend the debt brake and rolled out one of the biggest waves of public spending in decades. At the heart of it is a €500 billion infrastructure and investment fund. It's aimed at modernising railways, expanding digital infrastructure, upgrading energy systems, and accelerating the green transition. Defence spending is also getting another boost, with new exceptions carved out of the debt brake to meet NATO targets.
I think what is very important is having capabilities to spend for defense. That's a prerequisite for a growing economy to have security in Europe, not only in Germany.
The fiscal stimulus definitely helped to get Germany out of the stagnation that it's been in the past 6 years or so. But I think the boost to the economy will be quite transitory, focused on the next 2 years or so. After that, I think Germany is quite likely to return to fairly low rates of growth.
Germany isn't just fighting inflation or stagnation. It's wrestling with something deeper, an identity crisis. The model that once made it rich based on exports, manufacturing, and fiscal discipline is now being tested by a world that no longer plays by the same rules.
There is this culture in Germany of, being very fiscally conservative and afraid of too much public debt.
That mindset went hand in hand with a relentless focus on industrial excellence. Manufacturing became not just the backbone of the economy, but a source of national pride. Anne-Christine Aschleitner is a German economist and has sat on over a dozen corporate and non-profit boards in the country.
Ironically, this whole label "Made in Germany" was meant as a negative label. And so we really worked, to get this to this reputation, and I hope we keep it in the future.
Manufacturing has always been at the heart of the German economic model. We all know the German car industry has been doing very well, but also machinery goods, all kind of equipment, windmills, etc., just to name a few. But also the pharma sector is one of the biggest exporters in the world.
That model worked when global demand was booming. But today, China is making its own machines, the US is pulling back from global trade, and in Europe, consumers are holding back, making life more difficult for Germany's exports.
The reason why the car sector is struggling is that demand for cars in Europe is shrinking because the population is shrinking and incomes are rising very slowly. And cars last longer, so we change them less often. The other problem is that China is now producing cars itself, and it's producing also machinery and equipment itself. One thing that one could have imagined happening is Chinese EV producers, for example, that want to enter the European market, setting up facilities in Germany. What we're seeing, however, for example, is big investments from Chinese auto companies, for example, in Hungary, where obviously energy prices and also wages especially are lower. And we are seeing, for example, a bit of an EV hotspot emerging there, not only car production facilities, but also battery facilities.
With the change of China no longer just being a country where you export your goods to, but China rose to be a competitor. Chinese car makers are a true threat to the German car industry. Chinese R&D is much faster than R&D here. Just talk about artificial intelligence.
We have to see that we keep as much of export as is possible, but at the same time, it's obvious the world is changing and we have to reboot.
Germany's new economy minister Katharina Reiche told CNBC that adjusting regulations will be key to boosting Germany's competitiveness.
A smart regulation can shape market and can help economy. A regulation which is so tight, so precise on a micromanagement level that hinders companies to invest, that hinders startups to grow their businesses.
Other countries in Europe either went through this process in the past, like Italy, for example, the car industry is now very small. So they went through this process of, shrinking the industrial sector already in the past. And Germany also, had a much larger industrial sector to begin with.
Germany is also grappling with major external pressures, in particular the ongoing energy crisis and tense trade relations with the United States. Arne Franz is the CEO of one of Germany's biggest auto parts manufacturers.
Germany's economy and Europe's economy are very much built on free trade and on really strong exports, and we believe that all those products and services that the German and the European industry can offer to the world is so important for global wealth. So we continue to fight for free trade. In the meantime, what the Trump administration has really implemented is a huge stress on our supply chain, because as automotive suppliers can simply not afford to not pass on these additional costs to their customers. And therefore, in the end, it will be the U.S. consumers who will pay the price, who will pay higher bills for autos and other products.
When Russia cut off gas supplies following its invasion of Ukraine, it hit Germany especially hard. This chart shows just how reliant Germany was on Russian energy compared to its European counterparts, and energy prices soared as a result. That's been particularly tough for energy-intensive sectors like chemicals, automotive and steel.
We had a very big focus on environmental priorities before the start of the war in the Ukraine. Ever since the war started, the whole topic of environmental investments has actually taken a back seat. Nothing has happened when it comes to hydrogen grid, for example, but that's a crucial element as well for the energy-intensive industry, because they cannot just rely on electricity. They need hydrogen.
Despite these setbacks, Germany has made strides in renewable energy, laying the groundwork for long-term transformation. Robert Herrmann is the CEO for Germany Trade and Invest.
German energy generation through renewable resources, especially for electricity generation, is about 60% from renewables. That offers a lot of opportunities for companies with a focus on renewable products and renewable industry sectors for sustainable future developments of their technologies that they can find in Germany. And we can speak about that and give the opportunities here.
The war in Ukraine also prompted Germany to rethink its approach to defence. In addition to increased military spending, it's also modernising its defence industry. For decades, Germany's industrial policy was focused on peacetime manufacturing, but that's shifting.
So I believe that we can use the power of Germany's manufacturing sector in general and the automotive industry and us automotive supplier also to support bringing back the European armies and the German armies back to standards to really play their role in having a very strong and self-sufficient defense system for Europe.
With all of these challenges, it can be difficult to secure the investment needed for German businesses to thrive. Deutsche Börse AG operates several major financial markets in Germany, including the Frankfurt Stock Exchange and electronic trading platform Xetra. Stefan Leitner is its CEO.
Today we are too dependent on international capital flows, and therefore there's not enough baseline interest, there's not enough baseline investment. Institutional investors are often constrained from investing into German, European, but also international stocks. They're overinvested in cash deposits. German companies have always been very good in adapting. The agility that comes from the German Mittelstand connotation is a very powerful and positive development. At the end of the day, there's only a strength in that and not a weakness. Now, the point about the investment amounts that happen in Germany versus internationally, some of that is obviously a result of the fracturing of the geopolitical value chains that is going on.
But even as Germany grapples with these global headwinds and competition, some of the biggest obstacles remain at home, like slow progress on digitalization and cutting through red tape.
The new government has created a digitalization ministry, which didn't exist before. So clearly they're aware that that's an area of where intervention is needed as well. However, it's much more difficult to say how much progress they will make there in practice. It's not that easy, especially if you have all these established systems, to really change them overnight. Many governments in the past have said that they would cut bureaucracy and increase digitalization, and then very little happened in that area. Cutting bureaucracy seems easy said like this, but then you need to actually, change a lot of processes within the public sector and implement new ones and, implement all of this.
Looking ahead, the new Chancellor Friedrich Merz faces a challenging economic landscape. Despite a somewhat bumpy start, he and his government are tasked with navigating a deeply uncertain future for Germany's economy.
It was the first time in German history that a chancellor wasn't elected in the first round, and it came completely out of the blue. No one was expecting there to be any problems. That said, I think it's encouraging that he managed to sort the situation pretty quickly. He got elected in the second round after a few hours. So it could be that was just a blip and that things will indeed continue more smoothly from here. I think in any case for now, we can be fairly confident that the government will still be able, for example, to implement the big fiscal stimulus, increase in infrastructure and defense spending that they are planning.
In 2025, Germany's economy is expected to stagnate, with the International Monetary Fund projecting that the economy will shrink. Still, many are hopeful that the shift in priorities can spark new avenues for growth, with IMF projections showing GDP growth moving into the positive again from 2026.
I think one thing that is perhaps a good thing to watch in that sense will be the budget negotiations. Obviously, the budget was a big area of conflict within the previous traffic light coalition. So, for example, if Friedrich Merz manages to have a smooth process in terms of the budget, that would be a very good sign going forward.
So we have to reduce the energy prices by, for instance, investing in gas power plants to stabilize the security of supply. We will reduce energy taxes on the energy price to lower the burden.
Next year, it will be better, thanks in part to this big increase in defense and infrastructure spending that is coming. But yes, what we are unlikely to see is a return to those almost 2% growth rate that Germany had before the pandemic. The big problem that Germany has is that its population is aging. So, the share of the population that is in over 60s is going to increase a lot, and the population of so-called working age between 15 and 64, it's going to shrink. And it is going to shrink actually quite rapidly. So if we look at the population projections of the European Commission, it shows that in the rest of this decade, the German working age population is going to shrink, depending on the year, by between 0.3 and 0.8% in the worst years. So that's big. And that obviously means your employment cannot grow much. So that will be a very big drag on growth.
There is a lot of entrepreneurship happening. For example, last year we had a massive rise in startups, new applications. So I guess when it comes to the spirit of creating companies, of putting ideas into work, also in economic models, there is a good momentum in cities like Berlin, Munich.
I think it is really reforms in the area, like, for example, improving the business environment for startups. So cuts to bureaucracy, big investments in digital infrastructure, progress probably also in things like the Capital Market Union, also reducing trade barriers within Europe, so improving the single market. All of these measures that would improve the general business environments and make it more likely that new successful firms in areas that have a prospect of having growing demand in the future can emerge.
We have to be more open towards innovation and more risk prone. That was not our attitude, but that is important now in order to keep the pace of the world that is going. We have to make the economic environment more attractive, decreasing tax for the corporations and reducing labor cost. So that is what the new government should be behind.
Anything that gets older workers to work longer, anything that gets more women into the workforce, anything that incentivizes immigration, all of those things, that would be a big positive.
We have to kind of be open for taking more risks. When it comes to infrastructure, the next decade will be the decade of infrastructure investments in bridges, in energy infrastructure, in storage, in maritime infrastructure, telecommunication. And for this, we need speed. We need speed in investments and we need private capital.
There's a lot of hope on the new government. But of course, at the end of the day, the proof is in the pudding, what they all do with that gigantic fiscal package.
Germany has rebuilt before, from post-war devastation, from Cold War division, from the crash of 2008. But this time, it isn't rebuilding from rubble, but from rigidity. So the question now isn't just whether Germany can grow again, but whether it can change fast enough to lead in a very different world.